Well, welcome back to Live Impact News. Thank you for sticking with us for a extended break period there. We appreciate it. As you heard before the break, we had a few things to discuss to get our ducks in a row here, and part of that was bringing a very special guest into the studio. We'll see him on the occasional Tuesday here on Live Impact News. We see him every Tuesday on 13 News Now at 4. Tim Fitzwilliams from Fitzwilliams Financial. Welcome back. Is this a second home for you yet?
It's starting to become that, yes.
Okay. Now, when you walk in the front door here, are you just like, hey, I'm good, I know exactly where to go, or are you still get the escort?
I do get an escort.
Okay. Good.
Escort, so.
Yeah. We gotta make sure that
there's levels to this thing.
Just because we see you all the time, we still want to treat you with the appropriate amount of care here. Now, Tim Fitzwilliams has been answering all sorts of financial questions for us in 2026, including questions that you may have emailed in. Oftentimes those come at 4 p.m. So today we're going to kind of continue down that path, right? This first one, a little bit of a turn of phrase here. Something that you like to use is lose less in order to make more. Now, how do you sort of extrapolate on that?
Yeah, so I think that's the whole secret sauce to making money, really, is if you can try to have less volatility. So it comes down to this mathematical principle called the sequence of returns. And that just states that in a sequence of numbers, depending on where the volatility ends up, depends on how much you'll have at the end. It's really a unique phenomenon because let's say a husband and wife are both earning an average of, say, 8% over the course of 30 years. At the end of that 30 years, Connor, one of them could have a whole lot more than the other. So the idea is volatility matters. And so we try to target 25% to 50% less volatility than the market.
Okay, so that is your target. Volatility is what you're looking to. I guess when you frame it that way, how much of your policy do you base around that? Like how much of a factor is that? Do you almost look at that more than anything else when surveying the market?
That's a really good question. I'd say that's one of our core principles for sure. So much so that it dictates how active and tactical we are, because we focus on a daily upkeep and a weekly rebalance. So we're constantly looking at things to try to avoid volatility. And that's really important. And we'll see things like last year during the tariff tantrum, when there was this drop in the market, right? Our goal was to try to lose less then. When in 22, interest rates went up, bonds went down, our goal was to try to lose less there as well. And it's all about those snapshots in time. If you can do something different, if you can move a different way, then you can try to eliminate the volatility. And we believe if you can eliminate the volatility, you'll have more. It's really easy if you look at it like if you have $100,000, Connor, and you lose 50%, simple math, you have $50,000. But if you make back 50% on that 50,000, you're only at 75,000.
Right.
See, a lot of people get that confused. You're not yet back to 100,000. So that volatility really does matter. So if you can smooth that out, then you'll have a higher internal rate of returns.
Now, in terms of smoothing that out, we've talked about this, and this happens with most of the people that we're able to talk to who are experts in specific subjects. The most foolproof way for a consumer or a customer to make sure that they are being safe in their movements, whether it's financially, health-wise, whatever they may be, is to get in touch with experts. Find someone you trust. Take their advice. Allow them to guide you in that task. But if somebody was sitting at home and they said, look, I want to learn how to monitor these things, and I want to know how I can become more aware of potential volatility, what would you tell them to look out for? How would they do that?
I think anything's possible.
Yeah.
It's about how far do you want to take it.
Right.
I mean, it's buckle up. It's you're going to want to get charting services and news feeds of the market that you can trust on multiple different levels, and then you're going to want to get educated around how different things work, and it becomes an entire career. And so it's a question of, do you want to spend that much time out of your life trying to keep up?
And I know that the crowd that I'm referencing, certainly not, right? That's why they're able to work with experts who have dedicated their lives to that specific task. What kind of piqued my interest, though, is you mentioned the tariff tantrum.
Sure.
That, to me, seems like something where any person who is staying in touch with the news can see this tariff tantrum coming and maybe say, that's going to be volatile. Is that reasonable for people to be able to pick out?
I think
those?
It is reasonable. Where
Right.
it becomes difficult and not reasonable is to find out what are the exact movements, stocks or mutual funds or ETFs that you need to buy or sell, and what type.
Right.
That's the secret sauce. So logically up here, it makes sense, right? Okay, tariff tantrum, then I'm going to look at this, right? And in fact, when the NVIDIA drama was happening because a tweet went out saying that things could be more effective, NVIDIA dropped so people could do things around that. But it's about, do you know exactly which levers to pull? And that's where the training and the expertise comes in. And you mentioned finding an expert. I 100% agree with you. I take it one step further. Right. Is also the fiduciary capacity. You want to work with someone that's going to put your interests ahead of their own.
Yeah, and we talk about, almost making your financial portfolio as successful as possible, driving that spaceship. Maybe you can see that, hey, there's a meteor we need to avoid, but to have the person who's actually able to steer the ship maybe is a little bit of what you need to fully execute that vision and that plan. That makes perfect sense. I completely understand that. Now, how much of someone's success depends on market returns versus savings rate? How critical is that comparison?
That's a great question. And I look at it, it's three different things that are needed in order to be successful in the market. You need to have capital to invest. So there's our savings. We need to have time, and we need market returns. And what you'll find is uniquely interesting is that if you're short on one of those, you need to be heavier on the other two, which is also a great opportunity for younger folks because they have the time and they can start a good savings model. So then they may not need to leverage themselves as much or to take on as much risk. Because the name of the game is to take on as little risk as possible to get to your goals. Yeah. You don't want to take excess risk. But it's those three things.
Yeah.
You need the capital, you need time, and you need market returns.
And it's something you and I actually have discussed in the past on this platform, but I want to hone in on time. When you say time, how much time and why is that so important?
Well, that's a great question, too, is as much time as you can possibly get.
Yeah.
Unfortunately, that's limited by a lot of people's means. So you do what you can, and then you start to try to figure out what is a rational rate of return for my risk tolerance. And that's when you really get into how much risk am I comfortable with taking over what period of time to achieve the goal that I want to achieve.
And so the more time you have, the more likely it is that you are going to get the positive returns that you are looking for.
More likely, yes.
And at a lower risk sort of approach.
Because you have more time and you've had longer time to save as well, because that's a huge component.
And having all three, that's ideal. But you said
that'd be perfect,
if you have two of the three, you can make it work if things break
because
for you.
Exactly.
Yeah, and that is capital, time, market returns. That's your holy trinity right there of making it work. Now, when it comes to trimming winners versus letting them run, can you kind of explain that principle?
Sure.
What do you mean by that, and how do you kind of monitor which one to choose at
Absolutely.
any given time?
So we take that very serious. At Fitzwilliams Financial, we focus on a daily account viewing. So every day we're looking at something. So if something happens today in the news, we will make a move today. But we also focus on a weekly rebalancing. And so that's what we're talking about, trimming, right? So when you take a risk tolerance, say you're a 60-40 person, you're 60% stocks and 40% bonds as your risk tolerance, and something goes off really well. It does really well. And that shifts your risk tolerance, right? Because it did really well. Now you're maybe not 60-40 anymore. You might be 65, it might have changed a little bit, right? And so then you sell to trim that back down to your risk tolerance that you're supposed to be at. That's called rebalancing.
Right.
And we do that on a weekly basis because we believe it's that important. Going along that whole theme of what? Lose less to make more.
Yeah.
The more you can rebalance, the faster you are at making moves to be in and out of positions with a plan, mind you.
Right.
The better you're going to be. And I say with the plan because people buy thinking about the logic, but they also don't come up with a sell plan. We believe that when you buy something, you should make a sell plan at the exact same time. That way you're prepared no matter what happens.
Yeah. And do you find that once things maybe start going well, do people have difficulty sticking to that sell plan because they think, well, let's just keep this
Absolutely.
going? Yeah.
That's a big issue. People get emotionally connected, and stocks don't care about you, right? People say that they get emotionally connected because maybe their husband had that particular stock for so long or what have you, and there's no emotion in this. It's all business, and we have to look at it that way.
Right.
And so it's very important that we trim things down so that we can move on without being so exposed to risk.
And when we talk about the market and monitoring the market, we talk about the tariff tantrum, right? And obviously, when you are monitoring the market, keeping an eye on the political machinations of the country and the globe is obviously a massive portion of that.
Yes,
When
economics
we look at,
and politics.
we look at society as a whole, and we can kind of break it down into all of these subsets, right? There's politics, there's pop culture, there's maybe sports, there's music. They can go into different barrels. Are there other areas that you also, something like the Super Bowl happening, does that move markets in a sense? I mean, when an event that is that culturally important in America comes around, do you guys see that as something that will have an impact on what you do? Or is it just, it's a quick rise, a quick fall, and it doesn't have any impact on what you guys do in the
I would
market?
say it's more the latter. It's very little impact. You're looking for things that are going to create a massive change. Like when Putin invaded Ukraine, that created a massive change on different supply structures.
Right.
It's things like that. When you see something, whether prepared or not, if something occurs and it has a spillover effect that can affect a bunch of different markets, that's the stuff you're looking for.
Artificial intelligence
Yes.
certainly qualifies.
Absolutely, right.
Yeah.
Now, that's extremely important. That's what's creating a lot of efficiencies. Even though unemployment can be up, our efficiency is still up.
Yeah.
How is that possible?
Right.
You don't have the employees because people are becoming better at their jobs by using artificial intelligence.
Right.
So yeah, artificial intelligence is a huge factor. Not so much as like pick the right stock for it or whatever, but the concept of it, right? The concept of it is really affecting efficiencies in the workplace.
So we talk about Russia invading Ukraine, right? You know that is going to have long-term consequences for the market. The advent of AI, long-term consequences for the market. Do you have another example off the top of your head? I would love to explore like another one of those things that fits into that box.
Well, one happened in 22. I mentioned it earlier, but it's a good one. And we follow what we do is we follow the economic cycles. We break down those cycles into 6 cycles and the ups and downs of the market, right? The ups and downs of the economy. Well, when interest rates go up, we know bonds are going to go down. So that's something there that we saw in 2022. And again, our target was to lose 25 to 50% less than what the market as a whole, the S&P 500, was able to lose.
Yeah. And then, we talk about monitoring the financial and economic system. And we saw something that I found to be pretty unique, and it seems like based on some of the reaction, it is a little bit unique, and that is a revision in some of those jobs reports. Is that something you monitored? And if so, when something like that changes back so drastically, does that do you then have to reset with some of the decisions you made over the last 3-4 months?
That's interesting. It seems like the market is always ahead.
Yeah.
Right? So the market is always kind of betting on the future, it seems. So you don't so much have to go backwards because it's a now thing. Now, sometimes if it's dramatic enough, like if there was a major mistake, it might have an effect. But generally speaking, it's always betting on the next activity. And you're starting to see that change today for what it's betting on for tomorrow. That's the speculation effect.
Okay, so no matter, even if it is a quote-unquote revision, that's a revision that you are using to gauge the future.
Yeah, as long as it's not something dramatic and has a major impact.
Yeah.
And generally, those mistakes are not going to be so blatant. They're not going to. There may be small errors, but not something so wild that it was just way out there.
Yeah. Yeah, I gotcha. And then, people who are at home and doing all of the right things, but are surveying that future. And it's difficult, especially, you keep up with the news, which everyone is supposed to do, and I think is ultimately a very beneficial thing to keep tabs on, but at times can be scary, unquestionably, with the number of different things that, must be monitored and can be chaotic and can be looming and big and scary. Is there anything that you have found that people stress or worry about with their financial portfolios way too much. That they just need to take a step back from and not personally worry about so much.
I think as people start to retire, we notice most people are not spending enough. Most people are going to die with a lot of assets that they've saved up, and because they haven't had a written financial plan that lets them know how much they're going to spend. They may have financial assets, which is like 401ks, IRAs, TSP, alphabet soup, you name it, right? Brokerage accounts, stuff like that. But they don't have an actual written plan that talks about their risk tolerance, the rate of return that they should strive for, and what type of income they can receive in those later years. Right. I think a lot of people kind of just wing it, if you will. And so they end up not in spending. So what does that translate to? It means that you're not living your life to your fullest. You only get one life.
Right.
So we love to see our clients really enjoy that, spend the money, do the things that you want to do before you can't.
And you worked so hard to get to that portion of your life. You know, you put in 40, 50 years in the workforce so that you can retire and enjoy yourself, and very well deserved. But do you find that it is more fear or lack of knowledge?
You know, that's interesting. I think it's a little bit of both.
Sure.
I think at some level, people that put in 40, 50 years of the workforce, they've saved up enough. And I think their fear is running out of money. The number one fear that statistics say with retirees is a concern is the idea of running out of money. Now, that running out of money, I'd like to add on to that without changing your lifestyle.
Right.
So the idea is to keep your lifestyle the same all throughout your life. There's that old myth that you'll, not have to worry as you get older because you'll have less bills. That's not really true.
That doesn't come to fruition.
There's 80-year-olds walking around with cell phones and cell phone bills, and
a new car is probably nice once you hit retirement. Yeah.
So that doesn't really fit in today's world. So it's the fear of running out of money, and it's the lack of knowledge of what you can do. And it's not so much a lot of knowledge you can fill in on your own. It's really hard out there, Connor, in today's world with the S&P 500, the way that it's set up, that just about, depending on how you slice it, 37% of the S&P 500 is made up about 7-8 stocks.
Right.
That makes things really difficult. It's called concentration risk. So having the knowledge of how to have less concentration risk is a really hard thing to do. Again, it goes back to what we were talking about. Find that fiduciary, find that expert to help you have a diversified portfolio.
And you want your clients to have less concentration risk, but naturally you would also like the market to have less concentration itself, right?
We'd love to, yeah, but we find ways around that.
Yeah.
So our goal is to never hold more than 5%, and that's at the absolute maximum of one particular holding. And so still trying to keep up with returns becomes a very interesting dynamic of how you study things and what you're looking for, but it is doable. And that's what the experts do, is they study this stuff to try to find the holdings that's going to allow you to still stay diversified and not have concentration risk.
You talk about that concentration. You talk about 7 or 8 companies making up 35 to 37% of the S&P 500. When you look at a solution to that, is antitrust where you go, or is there another way that you think that could potentially solve itself?
Yeah, I've been asked that before.
Yeah.
It's funny. In your lifetime, my lifetime, we've seen it. You grew up hearing about Blockbuster, and then you didn't even know what streaming was.
Right.
And here we are on this, right?
I used to love Blockbuster.
Right, and here we are on this right here today.
Right.
So I think technology kind of solves itself.
Right.
I think capitalism will solve itself. Eventually something will come out that'll be better, and it will take it over. That's just kind of how it's always been.
Right, and just the last, 10, 15, 20 years, NVIDIA has made its way into that upper echelon.
Yeah.
So there are always risers and fallers, and I guess maybe what you would hope is that we can have multiple risers so that it's not just
it's
this
more
place
balanced,
is open and a new one takes its place. Like you said, Netflix takes the place of Blockbuster. What if you could have something rise to the top without necessarily losing another one of those options?
And maybe we will have more risers now that you have AI. You might have more ideas coming to the table because they're easier to execute. So then there might be more things rising at the same time.
Right. So that diversification in our portfolios, diversification in the stock market itself would be helpful as well.
Absolutely.
Now, when you look at, if people were to ask you, you talk about AI, right? And we've talked about NVIDIA. Is there another sector of society that you see becoming or being an even stronger major player in those upper echelon stocks in the future? I would even point to maybe 15 years ago, fast casual dining became something that became
right,
very,
like
very
trends?
lucrative, right? Like trends wise. And, is there anything that you see as maybe starting to breach that line? Is that the type of thing that you guys are even able to monitor, or are you just more?
Well, you're always keeping your ear to the ground,
Yeah.
right? You're always trying to hear what's going on. I think something to keep an eye on right now is this vaccine for cancer that's being discussed, right? That's going to get interesting, and how that would spill over. So that's one thing, right? I think technology is always something to pay attention to as AI develops, what it can and can't do, and how that leads into more efficiency into certain sectors that may have been more difficult. But if it can produce a widget more effective and at a lower cost, then that's something to keep an eye on as well.
Yeah.
And we're going to see that more and more, I think, all across different workplaces. Not necessarily high end, low end. It's just, I think, anywhere it fits, where people are looking to try to have more efficiency. I think we're going to see more of that. So I think technology as a whole, and then breaking that down, the medical side, and then the advancements of AI.
Okay, very good. And then obviously it's tax season. And when this time of year comes around, do you notice any differences in terms of, for lack of a better word, vibe of clients, customers? Is there a temperament change when it comes to tax season?
What?
Maybe more stress, more concern, or people maybe becoming slightly more aware during that month of their financial situation by default, and then that sort of leads to more questions or concerns?
Yeah, well, I think it's tax season. It's for the previous year, right?
Right.
So a lot of people get upset over nothing. It's more about what can you become aware about? What can I do now to change? A big thing that we're noticing really here locally, that people are starting to have real estate portfolios that are paid off, and they're not earning the amount per month that they should earn relative to the amount that's paid off, right? If you have $1 million paid off and you're not getting 1% a month, that's kind of not so good. So now people are like, well, I would sell it, but they don't want to sell it because of the capital gains, and they don't want to, do an exchange because they're tired of real estate. So what people are looking at, and one of the things that we're specializing in, is helping people reduce capital gains exposure through charitable means, and then providing them income that's giving them market-like returns.
When you say they're tired of real estate, can you elaborate on that? What is that feeling?
So eventually, if you have multiple pieces of real estate and they're all paid off, and you're earning money, and it's not going to be relative to the total amount that's paid off, right? Because it's a large number that's paid off, but you can only get $1,200 a month, let's say, on a $350,000 spot. So it changes up, right? The ratio is not as good the more it's paid off. Okay. In addition to that, you always have to go back. And I love real estate, so I'm not bashing this. It's just a fact. You always have to go back, beautify, and rehab and fix back up things every once in a while. And then sometimes bigger things come into play, like roofs and ACs and stuff like that. And then there's the day-to-day activity. Even if you're paying someone, eventually you just may get tired of dealing with it.
Right.
So there comes a point in people's lives where they're like, wait a minute, if I could just liquidate this and put it in the market, I don't have to worry about any of the headaches. But they don't because of the capital gains.
It's kind of stuck there a little bit.
Right. And most people's answer that they're aware of is, well, I can just exchange, right? Called a 1031 exchange. They exchange that property value into another property, but that's not what I'm talking about.
Right.
If you have charitable concerns and your heart is in that direction, there are ways that we can help eliminate the capital gains on your real estate portfolio and still get market-like returns, providing you income, which is very powerful. A lot of people are starting to take action on that because folks are now seeing the fruit of their labor and all the real estate they've had, and coming to a realization, you know what, if I could just have the cash instead, or the cash working for me better instead of the headaches, I'm at a point where I just like to do that.
Real estate, is sort of a headache-prone venture, not worth it, right? Still, like you said, you love real estate, but it can be a high-effort situation sometimes.
Oh, it definitely can. And until you hit critical mass, where you have enough that one issue is paid for by the masses, it's very difficult. And even when you hit critical mass, it just becomes a point of maybe you're just tired of it. And again, not getting the same return, right? Are you getting the right return relative to how much you have paid off? If you can put that money in the market and earn market-like returns, 7, 8, 9, 10%, well, that might be a better fit, right?
Okay, so we in your time here, we've talked about young people, new investors, all the way up to people who have paid off valuable real estate. So a wide spectrum of things to cover every time Tim Fitzwilliams is in the house. Anything else you'd like to express here before we let you go?
No, I just think it's very important not to try to be a market timer. As we see a lot of headlines, we hear a lot of things happening. It's great to research and to try to become informed, but really focus on talking to an expert who is a fiduciary that's going to put your interest ahead of their own, and get that good financial advice so that you can get a written financial plan. I can't tell you how many people have financial assets but don't have an actual written plan.
Right. And all about minimizing risk.
Absolutely.
And one way to do that is to lean on the experts in areas where knowing what you don't know is always a helpful sort of approach to a lot of things like this. Tim Fitzwilliams, we will also see you at 4 o'clock on 13 News Now.
Yes, sir.
All right, very good. Tim Fitzwilliams of Fitzwilliams Financial. He'll be back with us on our linear television station at 4 o'clock, joining us every Tuesday with valuable financial advice, expertise, and examination. We're actually going to take a quick break here. After we get back from the